Ladies and gentlemen, good day and welcome to Q3 and 9 months FY26 results conference call of Fredun Pharmaceuticals Limited, hosted by Fredun Advisors Private Limited. As a reminder, all participants' lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand over the call to Ms. Sakhi Manjiyara from Fredun Advisors Private Limited. Thank you, and over to you, ma'am.
Good day, everyone. On behalf of Fredun Advisors, I welcome you all to the Q3 and 9 months FY26 earnings conference call of Fredun Pharmaceuticals Limited. We have today with us Mr. Fredun Medon, Managing Director of the company, along with members of the management team, Mr. Rakesh, Mr. Gajanan, Mr. Khalil. Before handing over the call to Fredun sir to address your questions, let me briefly walk you through the company's performance for the quarter and 9 months ended FY26. During the Q3 FY26, total income stood at 160.92 crores, registering a strong growth of 57% year-on-year. EBITDA came in at 26.34 crores, reflecting a robust growth of 99% year-on-year. EBITDA margins improved to 16%, expanded by 384 basis points. Net profit for the quarter stood at 10.48 crores, nearly doubling with a growth of 96% year-on-year. Net profit margin improved to 7%, while EPS stood at 22.19. For the 9 months period, total income reached 426 crores, marking a 48% year-on-year growth. EBITDA stood at 65.66 crores, up by 74% year-on-year, while EBITDA margin improving to 15%, an expansion of 237 basis points. Net profit increased to 26.98 crores, delivering a strong 96% growth year-on-year. Net profit margin improved to 6%, and EPS stood at 57.13 rupees. Overall, the company has demonstrated strong revenue growth along with meaningful margin expansion and improved profitability during both the quarter and 9 months period. With that brief overview, I would now like to hand over to Fredun sir for taking your questions. We can now open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, please restrict your question to 1 per participant. Should you have a follow-up question, please rejoin the queue. And also, please note, do not ask repetitive questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abhi Jain from AJ Capital. Please proceed.
Hi, good afternoon. Am I audible? Yes.
Yes, sir, you're audible.
All right, perfect. Good afternoon to the team. Good afternoon to Mr. Fredun. I had a two-part question. The first part of that question was that given the growth that you're seeing, obviously it is higher than what you had anticipated. Do you see any immediate requirement for funds? Obviously, you've done a QIP and raised some funds, but and you said that the working capital cycle improvement will take some time. So I'm sure that cash generation might be chock-a-block for the short term. But in the next 12 to 18 months, do you think that the funds at hand are sufficient for the kind of growth that Fredun Pharma is seeing, or do you think that there will be another round of fundraise that would be required?
Okay. That's both part of your questions?
Yeah, sorry. And the second part is that given, the growth that you're seeing and obviously, the newer parts of the business, the Nutri and the pet care must be, contributing handsomely to the growth. I think that, the next 2 to 3 years, obviously, the kind of guidance that you have given seems to be a bit conservative. So can you just throw some light on that also? That's it. Thank you.
Sure. So addressing your first question, we are expanding quite rapidly. We are right now also increasing our production capacities at our current plants, and we have also added new partner facilities where we ourselves manufacture across various locations. So we have around 37 of those. Currently, the way we are anticipating that the new brands which we have launched in the last 2-3 years are suddenly taking a lot of traction. The growth that you have seen is because many of our products across various brands that we have launched in various segments that we have launched have picked up quite well and are doing very well in the pockets that we have launched them. So yes, we do not envision any sudden need of funds in the next 12 to 18 months. Business is dynamic. We are growing. If there are a need of funds, maybe after 18 months or 24 months or 13 months, we might look into it. If we have to raise funds for a different division or something, we might. There is nothing on the table right now, and there is no immediate need for any funds for that. The second part of your question was, if you can.
Yeah. So, just wanted to understand that given the growth that we are seeing in the company and obviously
the conservative numbers.
Yeah.
If you have seen my BSC guidances from 2016 onwards, every single guidance has been conservative. Because I do not, believe in, just giving a number and then if I overachieve the number, I'm comfortable. I don't want to be ever in a position where I'm underachieving a number. And we have to take into factor market situations. We have to take into factor so many of the situations that arise on a day-to-day basis. It's better to be conservative. Our conservative numbers are also robust growth. Our investors, our partners, the people who believe in us need to be in sync with the journey. And that is what I want. If we overachieve, yes, we might have a better guidance maybe next year or the year later. We are on track to achieving our guidances. We have taken buffers for any unforeseen circumstances that may arise, but currently the trajectory on which multiple of our divisions are going, I think we are quite comfortable in overachieving those.
Okay. Thank you, sir. Thank you for your time.
Thanks.
Thank you. The next question is from the line of Pritesh from Lucky. Please proceed.
Yeah. Hello, sir. So just one question. In the 9 months, what is the growth in the legacy business and the size of the legacy business? And what is the size of the new age business? If you could just give that split for the 9 months.
Yeah, so I have explained this in previous things. I'll again say the legacy business is pegged to grow at somewhere around 12 to 18% year on year. Hello?
Sir, I was asking your performance in the 9 months, what it has done.
Yes, I will address that.
Okay.
It is expected to grow at around 12 to 18% year on year for the next 5 to 6 years based on our registration. So last year, our exports, our direct exports were about 118 to 120 crores. Our institutional sales was around 40 crores. Our third-party business and our tolling business constituted for about 100 crores. So on that basis, this year, we will, on the 9-month basis, proactively, we have grown at around 15% to 20% on that.
Okay. Can you then tell us what is the size of the... Yeah, ma'am.
Mr. Singh, can you please rejoin the queue?
Why?
Hello? Hello?
Hello.
Yeah, I'll answer that question. Hello? Hello?
Yeah.
Hello?
Yeah.
Yeah. So I just told you. So the institutional sales, the export business and the third party business on last year, on that, about 110 crores, 45 crores and 90 crores will grow at around 15 to 18%, which it has grown. So that number will be somewhere around close to that same number as well, plus or minus a crore or two.
No problem. And how much is the size of the new business in the 9 months? How much portion of your revenue is now new business?
So the remaining portion of that business is the new age business. So this year we are pegged. This year at year-end closing, we are pegged to do somewhere around 60 crores of our GH business, around 42 crores of our pet care business, around 26 crores of our nutritional business, and that gives us a head runway to reach around 600 crores. And we are comfortable and around 550, 570 to 580 crores, and we will easily achieve those numbers. So the remaining part is the new age business, which includes mobility, which includes dermaceutics, which includes cosmetics.
And can you update us on the biscuits line, the pet biscuits line, what has it started and what revenue run rate it is?
The pet biscuits line is doing phenomenally well. The revenues and numbers, right now, we are adding more and more divisions right now and products. We started production in the second quarter actually third quarter of this year. So this quarter. So the numbers you will start showing in from this quarter and the next quarter onwards.
Okay, it will start showing from next quarter.
Sorry to interrupt.
No, the numbers will start showing from this quarter. The numbers will start showing from this quarter.
Okay. Thank you, sir. Bye. Thank you very much.
Thank you. Ladies and gentlemen, in order to ensure that management is able to address questions from the participant in this conference, please restrict your question one per participant. Should you have a follow-up question, please rejoin the queue. And also, please note, do not ask repetitive questions. The next question is from the line of Sayandeep from Eureka Stock and Share Broking Services. Please proceed.
Hello.
Yeah, hi.
Yes, you're audible, sir.
Hi, am I audible?
Yes.
Sir, just first of all, thank you for giving the opportunity and congratulations for the good set of numbers. I just have a simple bookkeeping question. We have seen a steep jump in finance costs as well as other expenses. Can you throw some light about that?
Any growing company and rapidly expanding company has always requires working capital. So certain things, plus we have changed our banks also. So, and we have taken new machinery loans also. So those all add up to the finance cost part of it. This will decline over the next 2 to 3 quarters. Because our fundraise money has come in this quarter, actually, on the third quarter. And we are going to sizably use it for working capital as planned. And also, we will have our own internal cash flows, which are improving, as you can see. So, it's part of growing a company.
Oh, okay. Sir, I just want to know about margin side. We have seen improvement in gross margin over the last 2-3 years. I just want to know, does this margin level sustainable for next 2 to 3 years? And what is your outlook on key raw material costs over the next 2 to 3 years?
Yeah, as any number grows, you guys are in the number business. Any number grows, the bigger it gets, you cannot sustain the same percentage growth. On a smaller number, you can sustain a percentage growth. On a larger number, it is not possible to sustain a number. It's not technically possible. But because our numbers are small right now, in the foreseeable future, we are okay to see it. There will be a sudden growth in the profits even further in the next 2 to 3 years because of the operational efficiencies coming into our high margin business, especially dermaceutics, especially our pet care, especially our new line of businesses. So you might, in fact, see a further jump in the profits coming in the next 6 to 7 quarters, and then it might have a gradual growth phase from there. So that's about it.
Okay, thank you.
Thank you. Before we take the next question, a reminder to all participants, anyone who wishes to ask question may press star and 1 on their touchtone telephone. I repeat, participants who wish to ask question, please press star and 1 on their touchtone phone. The next question is from the line of Dikshit Joshi from Whitestone Financial Advisors. Please proceed.
Hello. Hello.
So the participant has been disconnected. Can we move further?
Yes, sure.
The next question is from the line of Gaurav Shukla from Fin Investors. Please proceed.
Good afternoon, sir. I am audible?
Yes, good afternoon.
Sir, congratulations for good set of numbers, and thank you for giving me chance to ask question. Sir, one thing I want to ask, that deal has happened India and US and India and EU. What will be effect of this deal in this our company performance?
There will be no effect. We don't sell any products to US, and neither do we sell any products to Europe. Neither do we intend to sell any products to US. The companies which are manufacturing in Europe, who are planning to sell to India, will still be extremely non-competitive into certain of our products that we do. So overall, the products don't bother us. We are predominantly focused for the next decade to manufacture in India for India. So it does not affect our plans. It does not affect our numbers. Doesn't affect our profitability or our sales at all.
Okay, sir. In last con call, sir, it is written that we have outlined, you have said that in FY29, our revenue will be fully driven by vintage generics, and FY32-51 will be come from US business. That's why I have asked.
It's not US. It's new age business. New age, not US. 51% of our business will come from new age business.
Okay.
New age business is the brand that we
in transcript
mobility.
US, written is US. Okay, thank you, sir.
Maybe it might be a mistake. I'll get corrected. Not US business, new age business.
In last transcript, US written, so I have asked. Okay, thank you, sir.
Okay. No. Yeah.
Thank you. The next question is from the line of Kush from Care PMS. Please proceed.
Hi. I wanted to understand about the seasonality in the business. So generally, March quarter is heavy in terms of revenues, whereas margins are lower versus normal average. So what would be the reason for the same?
See, like all sellers, we are selling to importers, distributors, wholesalers. So like how we have a sale target, they have a purchase target. So if you see our numbers, if you see our business from 1995 onwards, our last quarter is always higher. It's a part of the business that we are in. And when you have a higher number, you have to give schemes, you have to give discounts, month-end schemes, year-end closing schemes. Each distribution, each retail, CNS and all those have targets that इतना लाख complete करो तो आपको ये products पे इतना discount मिलेगा, इतना लाख complete करो तो ये products पे ये discount मिलेगा. So definitely people would want to buy more. It allows our products to penetrate further into the market, and it allows our visibility of our products further. The idea of giving our products in bulk and sometimes giving a slight discount also on it allows that shelf pe hamare products rahe, and the more our products stay on the shelf, someone else's product is not on that shelf, and that allows us further growth as we go. As we go into a new age business, that seasonality will change. Because we're doing the pet care ethical marketing and also OTC marketing. We are doing cosmetics OTC marketing and dermaceutics ethical marketing. We are also planning specialized dermaceutics ethical marketing. We are entering into hormones. So over the next 5 to 6 years, the strong change in the last quarter will decline. I think all quarters will be the same. But the way our business goes, the first quarter is always the weakest, the last quarter is always the strongest.
Got it. And margins in the last 2-3 quarters have been improving. What would be the sustainable margin that we feel for our current business, say over the next 1-2 years?
See, anything over 5-6% is a great margin at the rate that we are growing. Because our top line is growing, our margins are also growing. Margin growth, you will see a sudden increase after a few quarters once the cost efficiencies of the new age brands start kicking in, because they are intrinsically higher gross margin products, 50, 60, 70% gross margin products. But right now we are in the placement. In some places we are in penetration, some places we are in repeat sales and diversifying our folio. So cost efficiencies, once they start hitting in, it will definitely hit our numbers. So if you see the margins, I would say what we have right now, we should consider it. As I said earlier in the call, I love being conservative.
So 5-6% you mentioned PAT margin.
Yeah, that's about it.
Okay.
Yeah.
Okay. Please continue, sir.
Yeah. So that will improve over time, as I've explained to you why.
Yeah, sure. And so continuing on the answer, how do you see the trajectory of new age business from here onwards, say by FY27-28? How do you see the growth and where do you see the mix?
I've said in multiple calls before, by 2029, 2030, 51% of the business should be from the new age business. That's what we are targeting. We are growing because we have smaller numbers right now, 20-25% growth in each of the divisions year on year. Some divisions are growing even faster because they have a smaller base. So we are quite comfortable in what we have. When you are launching a product across multiple states, you cannot directly determine 5% growth and 10% growth and 50% growth, because there are a lot of challenges that take place in launching the product. However, we have surmounted those challenges and we have still achieved a 20-25% growth year on year on the new brand since we have launched it since 2020. So we are comfortable on that growth path. The vintage business will grow at between 12 to 18%.
Right. Okay. Got it. Thank you so much, sir.
Thank you. The next question is from the line of Dixit Doshi from Whitestone Financial Advisors Private Limited. Please proceed.
Yeah, thanks for the opportunity. So my first question is, if you can give, as of December, how much is our inventory, trade receivable and loan?
Yeah, so those numbers are already in our balance sheet and our things which are declared. Inventories are on the same level as the quarter before, absolutely same level. And trade receivables have drastically reduced, but they are again dynamic as we are into local sales. Once it goes to the distributor level, the orders are cyclic. You don't send. We are not D2C company, so when in certain months you will have higher sales, certain months you will have lower sales. In December, I mean, on 31st March, if we have to consider in Indian market and at least a 90-day credit period, on 31st March, you will see a slightly higher debtor sales. If you see in the first quarter, you will see lower debtor sales. Same thing happened last calendar year also. So this financial year also. Last year, our inventory, our receivables were 177 crores, but we received almost 380 crores of receivables till September 2025. So again, our receivables went down to around 85 crores, even after the turnover increasing by 50 to 60%. So this is not a pharma sales, is where you have bulk sales and you don't have a daily sales, in the sense you don't sell everything daily on per day average. It is for 10 days you will have a lot of sales, then for 2-3 days, because of the production cycles, because the innate nature of business has this cyclic nature. So and quarter, sometimes production times are 2 months, sometimes they are 2.5 months, sometimes they are 1.5 months. So and quarters are sharp 3 months. So numbers will change quarter and quarter, but if a sharp financial analyst will understand the nature of business and see the kind of receivables averaged over the last 2-3 quarters, they will understand that yes, the receivables are quite robust and the creditor levels are remaining the same, and the debtor levels are the same. Plus the inventory is identical to what it was last quarter.
Okay, so more or less.
Sorry to interrupt, sir.
No, I am not asking the new question. Just reconfirming. So what you are saying that the trade receivables and inventory are more or less at similar level of what it was reported in September.
Yes.
Okay. Okay, I'll join back in the queue. Thank you.
Thank you. The next question is from the line of Lavneesh from Blue Ocean Asset Management. Please proceed.
Yeah, hi, Fredun. Can you hear me?
Yeah, hi. How are you?
Very well, thank you. I just have one question and one suggestion. My suggestion is that please, as part of your quarterly earnings release, please, provide us the breakup of the legacy business and the new age business. And that's the metric that most investors are actively trying to figure out. The second question that the question that I have is, the legacy business, with your current sort of establishment and cost, what kind of growth can you get in the new age business, and when do you think sort of the operating leverage will start to play out?
Yeah, as I said earlier, the vintage business, that's what I want to call it, the legacy business called the vintage business, and that will be growing at around 12 to 18% year on year for the next 5 to 7 years. The reason why it will grow at this percent is because we have about 1,300 to 1,400 registrations in the pipeline. Those registrations are going to keep on kicking in, and they're going to come on new age. In the new age business, the growth is about 20 to 25%. Operational efficiencies in certain parts, certain divisions. We cannot launch all states at the same time. We have to launch Maharashtra. Then after say 3 months, 6 months, we launch say Karnataka. Then we launch Kerala. We can't launch the whole India at the same time. Now Maharashtra will start getting operationally leveraged, say within 9 months. But now we have started Karnataka, so you are again going to be putting in funds and energy into that state. So considering that we are doing this off and on for the last 4.5 years for multiple brands, in the next 5 to 6 quarters, you will see a good set of numbers, and that is what I told the other participants as well, and a few other, the same questions that were asked earlier, that yes, between 5 to 7 quarters, you will see some kind of leverage coming in some kind of brands.
Sure. So the only request I have is, going forward, quarterly earnings release, please try and give the revenue breakup between sort of vintage and the new age business. So that's the only suggestion.
Sure, we'll do that.
Thank you.
Sure, it's a good suggestion. We'll keep that in mind. Thanks. Appreciate it.
Thank you.
Thank you. The next question is from the line of Ishika from Trinity Ventures. Please proceed.
Yeah, hi. Thank you for taking my question. I just wanted to know, as the new age business scales and takes a larger share of revenue in the mix over the next 2 to 3 years, how should we think about the manufacturing mix, like specifically the CMO versus in-house manufacturing? Will the new age business be more asset-light, or will it increasingly be manufactured internally?
Yeah, good question. There are certain products. Of course, one plant cannot manufacture every single product. We are into mobility products. We are into pet care. We are into herbal, nutraceutical. We are ourselves into pharmaceuticals. We have 1,700 products, but at the same time, we have other things. So there is a lot of variance in kinds of product type. Now we in our plants, in the cluster of 3 plants that we have, and the 4th one that we've just started, we are making somewhere close to around 2,000 kind of SKUs. But definitely, say like in our mobility range, we have walkers and we have wheelchairs, and we have so we are definitely not going to start a wheelchair plant and a walker plant and at least anytime soon. So of course, the new things that we are going to start is going to be asset light. It suits our things also. We don't want to start manufacturing everything we sell. We want to use someone else's cost efficiencies which have been achieved and use those to penetrate further into the markets that we already have. So say 4 to 5 years from now, more and more products will be manufactured not directly by us.
Okay, understood. Thank you so much.
Thank you. The next question is from the line of Keshav Tosniwal from Karnataka Capital. Please proceed.
Hi, Fredun. Congratulations for a great set of numbers again. I wanted to understand more with regard to mobility and beauty Fred brand, especially with regard to mobility. Like I see, like you visit any chemist shop, as there is a pamper section, there is a mobility section too. For a company like us who has always believed into penetration of distribution, like at least one product of Fredun should be there in like every chemist shop. How is the mobility going for us, and 3-4 years down the line, how big you see this mobility brand getting created? Because in mobility brand is just that product, right?
Yes. So, people, I'll just explain on the mobility front. People right now relate to mobility as knee brace, leg brace, back brace, right? But it has more than 800 products. We have also launched a Mobilytics brand, which is our brand. Our ortho brand is called Brace-On. Our say BP meters, our glucometers is called DG-On, and our nebulizers are called Neb-On. We have also launched a physiotherapist product-related brand called Mobilytics, Fredun Mobilytics, which also comes under the Fredun Mobility umbrella. So we are not only planning, we want and we will ensure that our products are there in most of the retail outlets. We are adding almost 30-40 retail outlets every week in the markets that we are doing right now consistently. The physiotherapy part of it are also being launched in April, where it will go to all the physiotherapists, and those products will be specifically tailored for the physiotherapists, which the physiotherapists can further sell to their clients and also utilize themselves. So that will encompass the entire range of the mobility segment and sector. So we are doing quite well. And step by step, we are going to launch these products. It is growing almost at 25 to 30% year on year. This year, we'll anticipate further growth also. I mean, I'm talking about the coming year, because we are adding another 4 to 5 states, and that will kind of complete almost 60% of India. These are volumetric products, so we cannot penetrate like a pharma products where you can just put in 20,000 packs. This, you have to put in 100 chairs, you have to put in 300 chairs, you have to get the market demand for it. You see the products, they will feel it, they will have a tactile understanding of the product. Then they will place further orders, because these are volumetric products. So penetration for any company in mobility segment is slow, but it is for us. We have got such a good response that we are now selling. I think one of the highest number of wheelchairs in the state. In Maharashtra, at least, we are selling practically most of the places in Mumbai have our products, and that will continue to go across states.
Sir, the line for the participant has been disconnected. Can we move further?
Yeah, sure.
The next question is from the line of Pal Balhar from Trinetra Asset Managers. Please proceed.
Hello. Thank you for giving me the opportunity, and congrats on good set of numbers. Sir, I just wanted to ask you, do we see any kind of inventory write-off in near future?
Inventory write-off is not possible our write-off of inventory is like 1,000 rupees, 1,400 rupees, 7,000 rupees, like that. Sometimes if there is any damage. Big inventory generally in pharmaceuticals, the innate inventory of the raw material is around 3 to 5 years. So there is no question of any pertinent write-off at this point in stage, or even in the conceivable future.
Okay. Thank you. That's it from my side, and all the best.
Thank you.
Thank you. Ladies and gentlemen, that was the last question from the participant. I now hand over the conference to Ms. Sakhi Panjiara from Kirin Advisors Private Limited for closing comments. Over to you, ma'am.
Thank you everyone for joining the conference call of Fredun Pharmaceuticals Limited. If you have any queries, you can write to us at research@kirinadvisors.com. And thank you for the conference call. Thank you, everyone. Good day.
Thank you. God bless. Thanks.
Thank you. On behalf of Kirin Advisors Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.